Hi, this is Joseph. Welcome back. In my prior videos, I expected higher interest rates, and here it is. 10-year interest rate increased from 0.9% at the beginning of the year to 1.6% at the time of this video. And the stock market didn't take it well. In today's video, I'll quickly explain why interest rates rose and how asset prices are determined. Then I'll walk through examples of how rising interest rates affect stock prices. At the end of this video, I'll explain if I'm buying, holding, or selling stocks at this time. When the news of the coronavirus hit in early 2020, the Federal Reserve cut short-term interest rates to zero, and bond investors started buying bonds, driving bond prices up and long-term interest rates down. Now, a year later, the Federal Reserve is committed to keep the short-term interest rates low, but bond investors acted differently. Apparently, the huge monetary and fiscal stimulus worked. As the coronavirus spread slows and the economy recovers, bond market investors are worried that higher inflation will come. So the fire sale of long-term bonds drove prices down and yields, or long-term interest rates, up. But what does this mean for asset prices? The price of an asset is closely tied to how much the asset is worth or valued at today. The present value of an asset, or how much the asset is worth today, is derived from how much value the asset generates in the future and how heavily the future value is discounted back to today. Let's go through two examples. By the end of these two examples, you'll understand why tech company stock prices fell more than others recently. Examples. We have a low growth company that produces $2 cash flow every year in the future for 100 years. On the other hand, we have a high growth company that produces no cash flow for the first 10 years. Then it produces $1 of cash flow at year 11 and grows that cash flow to about $16 a year in year 31. Then the cash flow reaches a steady state of about $16 a year until year 100. How do we value these two companies? We first discount back the future value of cash flow to the present by discounting it at a discount rate every year. For simplicity, we'll use 10% discount rate. For the slow growth company, we first discount $2 cash flow in year 1 by 1 plus 10%, or $2 divided by 1.1, and the present value of that is $1.82, the first blue bar. For year 2's cash flow of $2, we discount by 1 plus 10% twice, or $2 divided by 1.1 to the power of 2, and the present value of that is $1.65, the second blue bar. We continue until we discounted all the future value of cash flow to the present, represented by all the blue bars. Then we sum up the present value, or all the blue bars, and get $20. So the slow growth company is worth $20 today. Notice how cash flow in the far future is heavily discounted, so it doesn't worth much in the present. For the high growth company, we value it the same way. We discount future value to the present using the 10% discount rate for simplicity. From year 1 through 10, there is no future cash flow, so the present value is $0. But during this high growth period, from year 11 through 30, the present value of cash flow is quite healthy. Then the present value decreases as cash flow that is further out gets heavily discounted. The present value then sums up also to be $20. So both companies happen to be valued at $20 using the 10% discount rate. You may wonder why we discount future value. Because a bird in the hand is worth 2 in the bush. $1 you make today is worth more than $1 you make in the future. Now, when interest rates move higher, the discount rate will increase. With higher discount rate, we discount future value to the present more heavily. Repeating the same process, the present value of the low growth company's future cash flow shifts lower, going from the blue bars to the orange bars, by increasing the discount rate from 10% to 12%. At 10% discount rate, the blue bars add up to $20, but at 12% discount rate, the orange bars add up to only $16.67, a value decline of 17%. It's worth for the high growth company, but increasing from 10% to 12% discount rate, the present value of future cash flow also shifts lower, going from the blue bars to the orange bars. The new value of the company from adding up the present value is only $11.82, a huge decline in value of 41% from $20. So why did the high growth company decline more? That is because the bulk of the high growth company's cash flow is in the future. They're more heavily discounted and more sensitive to the changes in discount rate. Having understood how rising interest rate affects stock prices, I am less concerned about the companies themselves. This is simply a repricing of assets. I'll keep doing what I have been doing, that is to keep purchasing productive assets. The current rise in interest rates signals a healthier economy, and the price drops present better buying opportunities. I hope you enjoyed this video. To stay on top of current market events, you can subscribe to my channel and watch my other videos. I gotta go check out what's on sale in the market now. See you later.